Hello, very good morning to all. I'm Kelvin here. Welcome back to today's Daily Dose of Market Insights. I hope that you guys have a restful weekend. Very good morning. Welcome to a brand new trading week, which is going to be pretty much interesting and volatile. Very good morning. Today will be Monday, the 23rd of June, 2025. So before we get today's gist of today's Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right. Okay, so let's have a quick recap what has taken shape on last Friday, this weekend, most importantly, and as well as their impact on the various broad-based cross-asset classes that we cover on a daily basis. That is the major US dollar pair, the major stock indices, and the two key commodities market, which is gold XAU/USD and West Texas crude oil. All right, so let's start with Friday first. So on Friday, we do have the triple witching option expiry in the US. So that causes the US market to close more generally in the red. So the SPX is down by negative 0.22%. The Nasdaq 100 is down by negative 0.43%. The Dow Jones almost unchanged at 0.08%, and the Russell 2000 is down negative 0.17%. And primarily why the reason the Nasdaq 100 is the worst performer on last Friday, which is down by negative 0.43% among the four major US stock indices, is primarily driven by the weakness that is being seen in the mega cap technology stocks, especially Google, Amazon, and Nvidia, which are down by an average of negative 3% to negative 1.5%. All right, so given the fact that the mega cap technology stocks has a highest weightage in the Nasdaq 100, and one of the reasons why the semiconductor stocks underperform, primarily the Nvidia, which is down by negative 1.2%, it was a negative news flow coming out from US that could actually stoke US China tech war, okay, on the up or on the rise. All right, because there's a report stating that there's this new possible limits on China, where we start to see chip stocks, foreign chip stocks that is listed in the US, like shares of Taiwan Semiconductor and other chip makers, which is Nvidia, slide on Friday after Wall Street Journal reported that the Trump administration is considering further restriction on China. So basically, a US official told top global semiconductor makers, that means international, like TSMC, Nvidia, that he wanted to revoke waivers they have used to access America equipment in China. So basically, preventing further technology know-how, and we call it chips exporting, even though they built their plant in China, having some form of waiver initially, and the US official attempting to actually remove this waiver. That means, i.e., further preventing China from obtaining all sorts of technology know-how and even lower tier chips into the China semiconductor industry, despite the fact that these international semiconductor firms have already manufactured plants in China. All right, so that causes a negative feedback loop in the mega cap technology stocks, primarily the US semiconductor stocks like Nvidia on last Friday, because this move is expected to escalate trade tension between these two superpower that has yet to be kind of definitely a resolve, because right now we only have that 90 days trade tariff pause that was actually agreed between these two superpower around 2 weeks ago. All right, And also primary focusing will be on the rising geopolitical risk tension. So before I talk about the geopolitical risk tension, there's this Federal Reserve official speaking, stating that he is in favor of cutting interest rate as soon as July. But that actually kind of pale in the shadow, given the fact that stagflation risk is still pretty much prevalent in the US, and Fed funds futures market, as compiled by the CME Fed Watch 2, ignore this dovish Fed Wheeler speech, stating that Fed could cut interest rate as soon as July, because by the end of Friday, market participants in the Fed funds futures market, as compiled by the CME Fed Watch 2, still assign a high probability of 84% chance that the Fed on the 30th of July FOMC meeting will still maintain rates at 4.25% to 4.5%. And in fact, that was slightly increased from a week ago, which was pricing it at 77%. So if you look at it from a aggregated perspective, down the calendar, market participants is still assigning only 2 interest rate cuts potentially before 2025 ends. That means we do have a high chance of 78% that the Fed will enact its first interest rate cut for this year on the 17th of September 2025 FOMC meeting. Then thereafter on the October, it will stand pat, and almost certainty there will be another cut before 2025 ends, which is 99% chance right now based on the latest pricing by the Fed Funds Futures contract or Fed Funds Futures traders assigned to the various months Fed Funds Futures contracts, to bring it down to 3.75% to 4.5% on the 10th of December 2025 FOMC meeting. So currently, based on the CME Fed Watch 2, which based on its data obtained from the Fed Funds Futures market, traders in the Fed Funds Futures market only assign potentially 2 interest rate cuts by the Fed of 25 basis points each, one in September and one potentially in the December FOMC meeting. So they kind of do not agree with Fed Wheeler dovish remarks, which he spoke on last Friday, stating that Fed could cut interest rate as soon as July, because one of the reason why is because of the ongoing geopolitical risk premium that is rising up from the Middle East. So what we could see over here is that over on this Friday, on US time Saturday, that means which is Singapore time early Sunday, US actually attacked 3 Iranian nuclear enrichment sites and demands Iran to make peace over here. And this was despite a U-turn that was being made from US President Trump on last Thursday, stating that he has the intention to give Iran 2 weeks of grace period for diplomacy. That means allowing Iran to come back to the negotiation table. But unfortunately, this window of diplomacy has really closed after a US surprise attack on Iran on last Saturday US timing, which is US evening time. And Iran actually say they will retaliate, which it did over the weekend by striking Israel installation, reserve all option to respond, fire missiles at Israel. All right, so there's a big risk right now. Oil jumps on risk to supply as US stock futures drop over here. So the reason over here why oil actually jump at this moment in time, because of this risk of this Straits of Hormuz over here. So there is actually a risk right now, a rising risk, that the Strait of Hormuz will be kind of blocked by Iranian forces or Iranian proxies, a country that is friendly to Iranian forces, because there was this Iranian press TV reported that the Iranian parliament have approved a measure to close the Strait of Hormuz, which around 20% of constitute 20% of global oil and gas flow. So that is a significant amount of oil and supply flowing through the Strait of Hormuz. So if it's being blocked by Iranian forces, or we call it a country forces that is friendly to Iranian government, that could create a supply shock. So once a supply shock that is in place, potentially we may see more speculators pushing up oil prices. So if oil prices starts to increase, there could be stagflation risk flipping back globally, and that will potentially see the Fed hands tied to their hands, and not we call it igniting an interest rate cut pretty soon, and perhaps they may actually hold back their interest rate cut this year if oil prices continues to hit to $100 per barrel. So that actually explained to us a tightening liquidity condition potentially, and saw the Nasdaq 100 E-mini futures and the S&P E-mini futures both declining by 0.3% on the S&P E-mini futures, and the Nasdaq E-mini futures shading negative 0.4% as we speak in today's Asia session. And also because of this rising geopolitical risk tension, and we start to see potential stagflation risk, it could impact globally as well. We start to see the major Asian stock market also trading down lower as we are speaking right now. The Nikkei 225 is down by negative 0.6%. The Hang Seng now is almost unchanged. Previously was as negative 0.07%. So later I'll explain why Hang Seng is pretty much unchanged. It's actually due to the fact that this week there's this MPC standing committee meeting, which is considered as a high level policy China policy meeting. Potentially they could actually discuss about more stimulus measures that could be enacted in the coming months to counter with this ongoing situation, geopolitical risk tension rising, which is the geopolitical risk premium, on top with this ongoing US trade tension with China that has yet to be 100% resolved over here. So that has explained why the Hang Seng indices is neither almost trading to the unchanged mark as we are speaking right now. And the rest of Asia is still rather weak. We see the Kospi 200 down by, the Korean Kospi 200 down by negative 0.7%. Also the semiconductor heavy TAIEX, the Taiwan benchmark stock index, down by negative 1.5% after that negative news flow out from US on last Friday, threatening to cancel the waiver of TSMC exports that is flowing through China semiconductor market. And STI is down by negative, Singapore STI is down by negative 0.45%, with the AXX 200 also very weak as we're speaking right now, down negative 0.6%. So I would say that it's more of a risk off that we are seeing right now in the Asia benchmark stock indices, except we have an outlier in the Hang Seng index, which is the proxy of the China stock market. That is primarily driven by the anticipation of more physical stimulus measure potentially that could be announced by the end of the MPC Standing Committee meeting on Friday. All right, later I'll touch more about that. All right, over here. Okay, so now I want to share with you all one particular fundamental driver and intermarket correlation before we jump straight into the second segment of today's daily dose. Okay, but before I jump into that intermarket segment, let me touch on the FX market, which is very interesting right now. Right, so over the FX market over here, we start to see a jump in the US dollar as we are speaking, because of that the US dollar tends to be a proxy of safe haven, because US dollar tends to be a safe haven demand asset in terms of rising geopolitical risk tension in the past, and market participant is now trying to play the same playbook as well, especially against those risk on, risk off proxy currency. That means that is driving based on on stock market sentiment, primarily being seen on the Aussie dollar. So the US dollar is now pretty much strong against the Aussie, because Aussie dollar is a high beta currency that they tends to move accordingly, has a strong correlation with stock market performance. So given the fact that right now the stock market performance is more risk off than risk on, that means i.e. stock market potentially is declining right now, as I shared with you earlier on, that causes the dollar to be the strongest against the Aussie. And the Aussie has a strong correlation with the Kiwi, so they actually move in tandem. So if you were to, this is the 5-day rolling performance as we are speaking right now. So if we scroll down to the 1-day rolling performance, that only take into account of today's intraday performance over here, we see pretty mixed bag over here. So the one that is having the strongest dollar performance, like explained, is those high beta currency, which is the Aussie dollar. The risk has this strong correlation with the stock market performance, and also dragging along the Kiwi down as well. So the dollar is strongest against this high beta currency, the Aussie and Kiwi, but pretty much flattish against the rest of the other major currency like the Swiss franc, the Sing dollar, the yen, the dollar, China, CNH, which is pretty much controlled by the Bank of China, which is preventing it from inching up much higher, and kind of under, and the sterling and the euro actually outperform the dollar, because you look at the dollars sterling, means the $1 per one US dollar per sterling, $1 per euro, they are trading actually below the dollar index over here, slightly below the dollar index as we're speaking. So the dollar is down marginally against the sterling by negative 0.03%. The dollar is down marginally against the euro by negative 0.08%. So what we could see over here is not a real clear-cut US dollar strength. All right, it's only being seen primarily against the risk of high beta currency like the Aussie dollar. And primarily one of the reasons why the dollar strength is not showing a strong universally across the board is because due to, number one, stagflation risk in the US that could potentially worsen by the Trump's policy that is pulling away international US investors into the US sovereign bond market, which is the US Treasury market. Number one, potentially we have this ongoing erratic Trump trade policy, and one of this trade policy is to have a weaker US dollar in order to have US as a major manufacturing hub again, and also Trump's ongoing approval out from Senate in his one big beautiful tax bill that could potentially widen US fiscal budget deficit much wider, and that could actually deteriorate US finances and potentially lead on to a pullback of capital allocation to US Treasury. That means yes, lesser US Treasury, especially those long term, and that is actually dollar negative. So that actually explain to us why we are seeing right now we don't have a clear cut dollar strength across the board, only a dollar strength that's being seen in the high beta currency, the Aussie dollar, which indirectly has a direct spillover effect to the Kiwi. All right, so now let me touch on that fundamental intermarket correlation driver that I'm trying to share with you guys is the oil prices and US midterm to long-term inflation expectation. So what I'm going to do over here is how do I measure US inflation expectation, which is very important. Those are forward-looking inflation number, not your CPI number that is backward-looking. So this inflation expectation are being measured by the 5-year break-even inflation and the 10-year break-even inflation. 5-year denoted in dark blue, 10-year denoted in light blue. So basically, it's actually driven or get up from the market prices of US inflation protection bonds. All right, so that just strip off the inflation expectation. So from there, I'm able to get the break-even rates. So thinking of these break-even rates are market-based transacted prices, where market participants in the US Treasury inflation protected bonds have their view what US inflation rate will be 5 years from now, and what US inflation trend or rate will be 10 years from now. And you realize that both the 5-year and 10-year has been rather sticky on the upside, holding above US Federal Reserve target of 2 inflation, long-term inflation trend of 2%. So they have been inching upwards, the 5-year break even to 2.37% and the 10-year break even at 2.33%, pretty much similar. And what's interesting over here is that we start to see a higher low that's being formed on both the 5-year and the 10-year break even, and this higher low came in line with the recent spike up in oil price. So if the geopolitical risk premium continues to rise, there's pretty much a higher probability that oil price will continue to inch up much higher, and that could lead to a further rise in the 10-year and the 5-year break-even rates. That means forward-looking inflation expectation is expected potentially to soar higher above US Federal Reserve long-term 2% rate that they desired, and that could also potentially see the Fed funds rate to be at the current level longer than expected, at around the 4% level. All right, so perhaps the Fed may not even cut 2 times this year. They could start to change their expectation when we head into the Q3 of this year, and they start to actually potentially reduce the dot plot to only 1 interest rate cut, given that if stagflation risk continues to rise in the US due to higher oil prices. Right, so that could potentially see a liquidity squeeze in the US economy, and from that we could potentially see a medium-term downtrend unfolding in the major US stock indices. So later I'll share with you what are the key levels to watch on the major US stock indices on the intraday technical outlook. All right, so with that, that sum up the first segment. Let us now quickly go on to the second segment, which is the intraday technical outlook on those major cross asset classes, starting with the FX market. So before that, let me expand my screen. All right, so let's start with the FX market first on the euro dollar. So let's explain, the euro dollar remains rather firm today. So despite that earlier gap down that was seen in the start of the Asia session, prices recovered, and where it recovered right exactly at the pivotal support zone that we have on last Friday, and also the rising 20-day moving average, that is the euro dollar, that is still holding above it. So with this positive technical element, we have no conviction at this point in time to flip to a bearish bias, and instead maintain our bearish bias on the euro dollar using 140.40, 140.10 as my short-term pivotal support. First resistance to watch on today as we head into a European session will be 115.30. That provide a intermediate near-term resistance since last Wednesday on 18th of June. All right, so a breakout above 115.30 may trigger off a minor mini bullish breakout scenario to retest the intermediate range resistance that has been in place since 12th of June this year at 116.10. All right, so these are the two key resistance levels to watch on the intraday basis. However, if the euro dollar starts to shape a reversal to the downside and a bearish breakdown with an hourly close below 114.10, that would invalidate today's intraday bullish bias to see a deeper corrective pullback scenario unfolding, revisiting the next near-term support level at 113.60, which is the minor swing low area of 4th of June and 30th of May, and so confluencing with the rising 50-day moving average. Only a breakdown below 113.60 will trigger off a deeper corrective pullback towards the next near-term support zone at 112.70, 112.30. So that's for the euro dollar. Still watching 140.40, 114.10 as my short-term pivotal support, confluencing with the rising 20-day moving average in order to maintain our intraday bullish bias at this juncture. Up next, the sterling pound. So the sterling pound continues to actually still hold on to the 50-day moving average over here at this 133.95 / 133.70 short-term pivotal support level. So without that, still remains unchanged on the bullish bias that we have from last Friday, except that we have a lower first resistance to watch for today, which was this bearish we call it Marabuzu intraday candlestick that was being formed on last Friday at the start of the US session. Then after this breakdown, price action can break and trigger off that mini slide that we see so far. So that resistance level is at 134.80. Okay, 134.80. Let me put it in writing. 1 point. Okay, oops. Give me a bit of second over here. Okay, let me a few seconds in order for me to actually write it up. Okay, good. 1.3480. Okay, 1.3480 followed by 135.30, which is confluencing with the 20-day moving average, acting as the next resistance level. All right, only a bearish breakdown below 133.70 and hourly close below it will see the extension of the minor corrective pullback unfolding towards the next support level in the near term at 132.60, which confluence with the minor swing low of 15th of May and 16th of May, and as well as the lower boundary of this medium term ascending channel that I drew from the low of 13th of January this year. All right, so net overall still watching the 133.95, 133.70 pivotal short-term pivotal support, which confluence with the 50-day moving average, maintaining a bullish bias stance for a minor recovery on an intraday basis, with first resistance at 134.80. Above it exposes 135.30 next. So that's for the sterling dollar. Next up will be the Aussie dollar over here. So the Aussie dollar continues to break down, as we could see over here, given that this currency is a high beta currency that move accordingly to the risk on, risk off performance in general with the global stock indices. So given that global stock indices right now, most of them are in a weaker footing rather than a stronger footing. So that explains the Aussie dollar weakness against the US dollar, as it broke below our short-term pivotal support on last Friday, where we initially has a view for it to retest at the medium-term range top of 65.37, 65.45. So given the bearish breakdown of 65.55 and price action gap down, stage a rebound, bearish reaction of it, and now breaking below the 200-day and the 50-day moving average, and as well as breaking below the minor swing low of 29th of May and 30th of May at 64.07. So it seems to us that the price action of the Aussie dollar is about to actually float down back towards this lower limit of this medium-term sideways range that is in place since 23rd of April. All right, over here. So with that, we will flip to a bearish bias stance for it to actually potentially retest the lower limit of this medium-term sideways range at 63.60/63.65. That will be the support level that we're watching on today's intraday basis. Only a bullish breakout and a reversal, the hourly close above 64.55, that would invalidate today's intraday bearish bias to see a squeeze up to revisit last Friday minor swing high at 64.95 in the first step, and above 64.95 see a retest at that stubborn medium-term resistance zone resistance level again at 65.37/65.45. So watching 64.55, short-term pivotal resistance on the Aussie dollar, flip to a bearish bias for a risk to retest the medium-term range support area or support level at 63.60/63.50. Next up will be the dollar yen over here. So the dollar yen did a squeeze up above our short-term pivotal resistance that we have on Friday, which is 14610. So that invalidate our short-term bearish bias for it to float down back towards the middle part of the range, which is retesting the 50 and the 20-day moving average. But what's interesting over here is that the current RSI is not that rosy. The current RSI scenario observation is actually printing out a bearish divergence. Okay, what we see over here is price action move higher high. Oops, is it? Okay, price action goes higher high, right? It goes higher high, but the RSI slope a lower high. All right, and it's now trying to exit out from the overbought level, so indicating that the current push up is a bit overstretched over here. So with that, we do not have a strong bullish bias for today, given the bearish divergence condition that's being seen right now on the hourly RSI. So for now, I'll flip to a neutrality stance with the 14715 as my upper neutrality zone, which is the minor swing high of 14th of May and 15th of May over here. And if you do the Fibo extension from this ongoing bounce from the low of 27th of May, project it to the high of 29th of May, push it down to the low of 3rd of June, that also coincide very closely to 1.236% Fibo retracement. So with that, neutral between 14715 and 14610 for today for now over here. So unless price action starts to reintegrate below 14610, then potentially this bullish breakout in today's early Asia session considered as a fake hit, and price action may reintegrate back below the range at 14520 and 14450 in the first step. All right, so neutral for now on the dollar yen between 14715 and 14610 due to that bullish condition, due to that bearish divergence condition, pardon me, that is being seen on the hourly RSI at its overbought level right now. Great. So that sum up the intraday technical outlook for the major FX dollar pair. Let us turn our attention to the major stock indices, starting with the Hong Kong 33 over here. So what you could see over here is that the Hong Kong 33 tried to squeeze up in today's Asia session due to the anticipation of that so-called fiscal stimulus expansionary policy that could potentially be announced by the end of the MPC Standing Committee meeting on this Friday. But price action has really starts to show exhaustion on the bullish exhaustion by the shape of this impending hourly shooting star candlestick. Why still impending? Because we are still at the 11:30 a.m. It only ends at the 12 p.m. Singapore time. But nevertheless, there's some bearish reaction off here, and this bearish reaction took shape right exactly below our short-term pivotal resistance that we have on last Friday, 23,690, and that also confluenced with the pullback resistance of that former minor ascending channel from the low of 16th of April, now turns into a pullback resistance level, formerly a minor ascending channel support. So no change given that bearish exhaustion candlestick, which is the shooting star that is being impending shooting star that's being formed right below the 20-day moving average and right below the 23,690 short-term pivotal resistance that we have on Friday. Potentially there could be we call it a further potential weakness as the trading session unfold later in the afternoon. So still using 23,690 short-term pivotal resistance on the Hong Kong 33 representing the Hang Seng Index, maintaining our intraday bearish bias stance with first resistance, first support coming in at the swing low of today's opening, right, which is today's opening intraday low, which is at 23,260. All right, so let me put it in writing, 23,260. Okay, only a bullish, only a breakdown below 23,260 may revisit 23,060 next. However, if price action starts to have a bullish breakout and hourly close above 23,690, then the buyers shift back to the bulls for a recovery towards 23,900 and even retesting last Monday's swing high area at 24,240. So i.e. no change, still watching the 23,690 as my short-term pivotal resistance level based on the price action, the negative price action that is taking place right now, as I described earlier, maintaining our intraday bearish bias for the Hong Kong 33 with a slightly higher first support to watch, which is the today's intraday low at 23,260. Below it exposes 23,060 next. So that's for the Hong Kong 33. Next up will be the Japan 225 over here. So the Japan 225 is pretty unique based on the price action configuration. Is neither bullish nor bearish. Why? Because since the high of 13th of May, it continues to consolidate within this minor ascending channel, minor ascending triangle configuration with the upper limit showing similar high at range resistance of 38,550 and trading up a series of higher low holding above the 200-day and 20-day moving average. And on last Friday we were bearish because price action continues to cluster around the upper limit of the minor ascending triangle range configuration, 38,850, and now indeed slide down and hit our support level, which is the 20-day moving average and the 200-day moving average at 38,145. And right now that is showing some signs of a rebound over here. And given the fact that the hourly RSI also starts to bounce off from a parallel support level at around the 35 0.8 level. All right, so with that, I'll be using 37,820 as my short-term pivotal support for today, which is the lower limit of this minor ascending triangle range configuration. Flip to a bullish bias within this sideways range configuration for it to retest the upper limit of this sideways triangle range configuration again. On an intraday basis, first resistance level to watch will be 38,430, a breakout above 38,450, which was last Friday US session high that could retest the upper limit of that triangle ascending triangle range resistance at 38,850 next. Only a bearish breakdown and hourly close below 37,820 that could invalidate today's intraday bullish bias to trigger off a bearish breakdown from the ascending triangle range configuration, exposing the next near-term support level at 37,270, which is the minor swing low of 3rd of June, 6th of June, and as well confluence with the rising 50-day moving average. All right, so that's for the Japan 225. Next up will be the Germany 30 representing the German DAX. So the Germany 30 squeeze out as expected to hit our counter trend rebound scenario resistance, which is at 33,510 before shaping off that bearish reaction. And that also uh, uh, occurred right exactly at the upper limit of this ongoing descending channel that is still in place since the all-time high of 5th of June over here. And given the fact that the hourly RSI right now has kind of broken down as well and below its former parallel ascending trend line and inch below the 50 level mark, hasn't yet hit the oversold region of below 30, there could be a risk that this bearish reaction of 23,510 is the start of another minor impulsive down move. And given the bearish condition that's being seen on the hourly RSI, right now we will be flipping back to a bearish bias stance for the Germany 30 using 23,510 as my short-term pivotal resistance level. First support level to watch will be 22,910, which is the minor swing low of 6th of May, and as well as the 0.618 Fibo extension on the downside, taking from the high of 5th of June. Below 22,910 may expose 22,630 next. 22,630 is actually the lower limit of this ongoing minor descending channel, and as well as the former minor swing high of 1st of April and former minor swing high of 30th of April, previously broken out, now turns into a pullback support level. Only a bullish breakout above 23,530 or 23,510, pardon me, that means i.e. a bullish breakout and an hourly close above 23,510 that will invalidate today's intraday bearish bias to see the continuation of the counter trend rebound unfolding, exposing the next near-term support at 23,710 and even 23,880 potentially. That also confluence with the 20-day moving average. So flipping back to a intraday bearish bias for the Germany 30 using 23,510 as my short-term pivotal resistance level. Next up will be the major US stock indices, starting with the US Wall Street 30, representing the Dow Jones Industrial Average. So the Dow Jones Industrial Average last Friday did a little bit of bounce, but that bounce failed to actually kind of a, okay, give me a minute, let me draw a proper one. Okay. Okay, failed to take out the pivotal resistance level at 42,350. All right, so this 42,350 was tested on last Friday before it did that bearish reaction, and today's gap down from it. So it also confluenced with the 20-day moving average as well. So no change, still using the 42,350 as my short-term pivotal resistance level, which indeed resisted last Friday bounce. Maintain that intraday bearish bias. First support level to watch for sure will be the 41,815 that managed to survive on last we call it Thursday, 19th of June. A breakdown below this level may expose further weakness towards the next near-term support level at 41,530, which confluence with the 50-day moving average, and as well as the lower limit of this minor descending channel from the high of 12th of June. Only a bullish breakout above 42,350 and the hourly close above it will invalidate today's intraday trend bearish bias to see a squeeze up to retest the swing high area of 16th of June at 42,580 slash 42,700, which is also confluence with the 200-day moving average. That's for the US Wall Street 30. Next up will be the SPX 500. So the SPX 500 gap down today below the 20-day moving average after a bearish reaction on last Friday, option expiry day at the 6,008 level. We also the minor descending trend line pullback resistance from the low of 13th of June, formerly a minor ascending trendline support, now turns to the pullback resistance level. So given the fact that price action still managed to survive at the 5,920 critical near-term support since in place since 13th of June, survive on last Thursday and also survive in today's Asia session. So this is very critical near-term support level. Take it as a downside trigger level. So given that this downside trigger level has not been breached on the downside, I do not want to tighten the short-term pivotal resistance to be so tight at 6,008. So still maintaining at 6,050 unless we very clearly see a hourly breakdown with hourly close below 5,930, that I'll be much more confident to tighten it to 6,008. So for now, levels remains unchanged and maintaining the same bearish bias for today on the US SPX 500. 6,050 short-term pivotal resistance level, downside trigger level 5,920, breakdown below it exposes the key 200-day moving average, conferencing with the next support level to watch will be at 5,800, the minor swing low of 27th of May and 30th of May. Only a bullish breakout and hourly close above 6,050 that would invalidate today's trend bearish bias to see a set stage for a recovery on the US SPX 500. That means i.e. the start of another new bullish impulsive up move sequence, potentially revisiting the next resistance level at 6,093 in first step, then thereafter the current all-time high level at 6,151. So that's for the SPX 500. Next up will be the NASDAQ 100, very similar with the SPX 500 as well. On option expiry date on Friday, it rejected exactly at our first resistance at 21,890, but in today's Asia session managed to survive at the downside trigger level again at 21,500. That managed to help the bears in check for the NASDAQ 100 since 13th of June. So this is like a downside trigger level for sure. So no change because this downside trigger level has not been broken down to the downside. I do not want to squeeze my pivotal resistance to be so tight at 21,890. Still remain the same at 22,050 unless we have an hourly close below 21,500. So 22,050 short-term pivotal resistance, maintaining our intraday trend bearish bias for the NASDAQ 100. Downside trigger level 21,500, breakdown below it exposes the next near-term support level at 21,180, 21,030, which is the minor swing low area of 30th of May and 2nd of June. Only a bullish breakout and hourly close above 22,050 that would invalidate today's intraday bearish bias to see the start of the another fresh move of a bullish impulsive up move sequence, retesting the 22,200 slash 22,250 all-time high area in the first step. So that sum up the intraday technical outlook on all the major stock indices. So let us now focus on the commodities asset classes, starting with the gold XAU/USD. So gold XAU/USD last Friday we were pretty neutral between 3,400 and 3,3346, which indeed price action trade within this range, and this 3,346 is pretty important because it's confluence with the 20-day moving average and as well as the minor ascending channel support from the low of 29th of May. And what's interesting over here is that the hourly RSI has started to shape a bullish momentum observation. Why do I say so? Previously, we start to have a bullish divergence that's been seen on last Friday at the start of the US session. Price action retested 3,346, same low, but higher low is being seen on the hourly RSI. Hourly RSI did a bullish breakout as the US session unfold, and right now there was a gap up earlier in Asia session, and after that the price action dwindled downwards. But it dwindled downwards, the RSI now managed to bounce off from that former descending trendline resistance now turns into a pullback support level and starts to form a series of higher low after that bullish divergence that's being seen on the start of the US session on last Friday. So given this positive observation on the hourly RSI indicating some form of bullish momentum revival, we will flip to a bullish bias for today for Gold XAU/USD using 3,346 as my short-term pivotal support level. First resistance level to watch remains unchanged at 3,400. Above it may see a probe at the next resistance level at 3,423 in the first step for today's intraday session. Only a bearish breakdown and hourly close below 3,346 that would invalidate today's intraday bullish bias to kickstart the extension of this corrective decline sequence from the high of 16th of June, exposing the next near-term support zone at 3320/3302, which confluence with the rising 50-day moving average. Next up will be the West Texas crude oil. So the West Texas crude oil continues to actually push up higher, and it also managed to formally clear above last Friday, the 13th of June Friday minus swing high area at 75.40. So this swing high area was being formed during the first Israel airstrike on Iranian key installation, and today's price action is staged a gap up, hit our first resistance that we mentioned on last Friday, where we maintained our intraday bullish bias at 77.60 before doing that pullback over here. So far, no very bullish exhaustion sign that's being seen on the hourly RSI, no bearish divergence. RSI hasn't hit the overbought level yet. And right now, price action seems to be trading within this parabolic ascending channel that I drew from the low of 30th of May. So with that, we will have a tightened short-term pivotal support level, which is the gap up that's being formed in today's Asia session, and as well as pretty close to the parabolic ascending channel lower limit at 75.40, confluence with last 13th of June, the previous Friday, the prior 2 weeks Friday, 13th of June minus swing high area, and as well as Monday minus swing high area during the Asia session of 16th of June at 75.40. So 75.40 will be my tightened short-term pivotal support level for today, maintaining my intraday trend bullish bias for the West Texas oil. First resistance level to watch will be 77.60. That see that pullback in today's Asia session above 77.60 may expose the next near terms resistance level at 80.30. The 15th of January 2025, 15th of January 2025 swing high slash 81.90. All right, over here slash 81.90, which is the 0.618 Fibo extension taken from the low of 5th of May this year. All right, only an hourly close and a breakdown below 75.40 that would invalidate or negate today's bullish bias scenario to see a retest on last Friday's swing low at 73.70. Only a breakdown below 73.60, pardon me, a breakdown below 73.60 may trigger a start of another corrective decline to retest the key support area at 70.60/69.15, which is the former minor descending resistance from 28th of September 2023 now turns into a key pullback support, and as well as the key 200-day moving average, all confluencing at 70.60/69.50. Right, so IE still maintaining our intraday trend bullish bias on West Texas oil with a tightened short-term pivotal support at 75.40 for today. All right, so that sum up the intraday technical outlook on all the broad-based cross asset classes. So before we go, let's take a quick look at the economic calendar. What are the key data to look out for today? So the key data to look out for today will be a PMI day for today as we head into the European session. Today we'll see a slew of release of preliminary PMI data compiled by the S&P Global Company out for the month of June. So for Eurozone, it will be out at 4 p.m. Singapore time today, manufacturing flash PMI and services flash PMI. And at 4:30 p.m. we have the UK manufacturing flash PMI and the services PMI to look out for. And as we head into the US session at 9 p.m. Singapore time, we will have ECB President Lagarde speaking, so that could potentially influence the euro dollar, the euro cross rate, and the Germany 30 index. And 9:45 p.m. we have the S&P Global Manufacturing PMI flash and S&P Global Services PMI flash up for US for the month of June over here. And 10 p.m. we have a Fed Bowman speech, 10 a.m. Fed Goolsbee speech over here. And also as we head into the 24th of June, which is on Tuesday, Asia session, we will kickstart this first day of the National People's Congress Standing Committee meeting, which I mentioned earlier in today's Asia session. So it will stretch out all the way up to this Friday. So by the end of the Asia session, there could be some local press report from China or from Hong Kong, potentially reporting what the committee members discuss about during this 4-day of session. And it's very important because it consists of the top policy makers of China taking part in this standing committee. So market participants will be hearing out for, is there any chance of further fiscal stimulus policy that could be enacted in the coming months to negate the ongoing geopolitical risk tension, and as well as the ongoing trade and trade war tension and tech war tension with China and US that is still ongoing in the background. All right, so that sum up today's daily dose of market insights. I'm Kelvin here signing off, wishing you a great day ahead, and we shall speak again tomorrow. Thank you.